Hello, everyone, and welcome to The Explainer. Today, we're unpacking an absolute masterclass in modern corporate strategy. When you think of Coca-Cola, you probably picture the secret formulas, the brilliant marketing, those iconic red cans. But right behind the curtain of all those glossy ads, there's a massive, incredibly complex industrial machine. And, well, that machine is about to undergo a total transformation in one of the world's fastest-growing markets. Okay, let's dive right into this. $10 billion. That's the target valuation for what could easily be India's biggest FMCG IPO in years. The Coca-Cola Company is officially signaling its intent to take its primary Indian bottling unit public. We're talking about unlocking massive shareholder value here, completely changing how the beverage wars are fought, and honestly, rewiring how one of the most famous brands on earth does business in an absolutely crucial region. To really grasp the magnitude of this move, here's our roadmap. First up, the billion-dollar IPO. Then, syrup versus soda. Third, the asset-light strategy. Fourth, the Pepsi precedent. And finally, why India? All right, Section 1, the billion-dollar IPO targeting 2027. Let's just look at the sheer scale of the news and set the stakes here. So here are the hard facts of the proposed offering. Coca-Cola is targeting the year 2027 to list Hindustan Coca-Cola Holdings. We'll just call them HCCH. They're expecting to raise over $1 billion, aiming for a valuation well north of $10 billion. That's roughly 85,000 crore rupees. And they've brought in the heavy hitters to steer the ship. Advisors like Rothschild & Co., Kotak Mahindra, HDFC, and Citibank. But here's the absolutely crucial takeaway. This is a pure offer for sale by the parent company, meaning Coca-Cola isn't issuing new shares to raise money for the bottler. Nope, they are selling off a portion of their own stake to the public to cash in on their investment. Part 2. Syrup versus soda. The Coca-Cola model. To really get why they're doing this, we kind of have to challenge our assumptions about how a massive global brand actually works behind the scenes. It's a tale of two companies, really, and this brilliantly illustrates the Great Divide. On one side, you've got the brains and the brand, the Coca-Cola Company itself. They handle the global strategy, they make the high-margin secret syrup. Honestly, it's a highly profitable business. It's almost like shipping lightweight digital code. But then, on the other side, you've got the brawn, Hindustan Coca-Cola Beverages. They do all the heavy lifting. They own the bottling plants, the vast fleets of trucks, and they manage the incredibly gritty reality of physically moving millions of gallons of heavy liquid all across a massive country. Just think about the sheer logistical magnitude of this bottling arm for a second. We're talking 14 bottling plants, 8 co-packers, operations spanning 10 states and 236 districts. They've got over 5,200 employees, and they're serving over 2 million retailers. And hey, they aren't just pumping out Coke either. They produce incredibly popular local brands too, Sprite, Maaza, and Thumbs Up. And Thumbs Up alone is a total titan in the Indian market. Managing this side of the equation, it requires heavy machinery, immense capital, and some seriously complex local logistics. Which brings us to Section 3, the asset-light strategy, or refranchising. Let's shift our focus to the financial engineering that's driving this massive structural change.
It begs the big question, doesn't it? If this bottling network is so incredibly vast and successful, why on earth is Coca-Cola selling off its own factories and distribution networks?
Well, the answer lies in a concept that Wall Street absolutely loves. It's called the asset-light strategy, or refranchising. By shifting all that capital-heavy manufacturing and distribution over to local partners, the parent company gets to focus strictly on what it does best, selling that high-margin syrup and marketing the brand. This isn't a retreat at all. Actually, scratch that. It's more like a brilliant, agile chess move. It transforms Coca-Cola from an owner of bulky factories and trucks into a leaner, hyper-profitable licensor. It literally restructures and expands their profit margins. And you can actually already see this strategy playing out in their financials. Recently, the bottler reported a 9% year-over-year revenue decline for fiscal year 25. Now, on the surface, a 9% drop sounds bad, right? But this wasn't because people stopped drinking Coke. No, this was a deliberate result of selling off specific bottling territories, like Rajasthan, Bihar, and the Northeast, to independent franchise partners. The revenue just moved off their direct books. It's all part of this grand refranchising master plan. Let's walk through how this actually evolves. Historically, Coca-Cola owned 100% of this holding company, the whole shebang. But then, in July 2025, they took a massive step by selling a 40% stake to the Jubilant Bhartia Group, a huge Indian conglomerate, for roughly 12,500 crore rupees. That brought in a partner with serious, deep local operating muscle. The next step is this 2027 public listing, which is going to dilute Coca-Cola's stake even further. Eventually, day-to-day operational control transitions almost entirely over to these local partners, while the global parent just sits back and collects that sweet, high-margin concentrate revenue.
Section 4, the Pepsi precedent, Varun beverages. Now, if you're wondering whether this strategy actually works in the real world, investors have seen this exact playbook run before in India, and, spoiler alert, it ended incredibly well. Now, what's really fascinating here is the direct comparison to Pepsi's highly successful Indian bottler, Varun Beverages. Varun already operates on this exact franchise-led model and accounts for over 90% of Pepsi's beverage volumes in India. Look at the numbers. Varun Beverages is already a publicly listed giant with a market value of around 1,000 and 10,000 crore rupees, trading at roughly 8 times its sales. Coca-Cola's target of a $10 billion valuation puts it at about 7.5 times its fiscal 25 sales. So what does this tell the market? 2 things. 1, the model is undeniably proven to generate massive wealth. And 2, there's a very clear valuation benchmark, and honestly, a lot of potential upside if Coca-Cola's bottler can match Varun's phenomenal trajectory on the public markets.
Section 5, Why India? The macro perspective. All right, we know the what and the how, but let's zoom out a bit. Why is Coca-Cola executing this maneuver right now? Simply put, the scale of the opportunity here is staggering. India is already Coca-Cola's 5th largest market globally by volume. But the real story is the runway for growth. It is absolutely massive. With a young, rapidly expanding population and a rising consumer class with more disposable income in their pockets, India's per capita beverage consumption is actually still well below the global average. So, capturing this market, it isn't just about maintaining the status quo. It's about securing the brand's global growth engine for the next several decades. But there's definitely a defensive reason here, too. The beverage wars in India are heating up fast. While legacy brands like Coke and Pepsi have historically dominated the landscape, fierce local challengers are emerging and gaining ground quickly. Brands like Coca-Cola are aggressively expanding, and they're estimated to have already captured between 10 to 15% of the market share. The environment is becoming hyper-competitive, and operating with heavy, slow corporate machinery, that's a huge disadvantage right now. And that brings us to our final thought. By spinning off its bottling arm, Coca-Cola is essentially placing the day-to-day fight directly into the hands of specialized, highly motivated local partners. This frees up the parent company to focus entirely on what it does best: brand warfare and innovation. So the question you really need to take away from this is, will shedding its heavy machinery give Coca-Cola the agility and the capital it needs to ultimately win India's intensifying beverage wars? It's a fascinating strategic gamble for sure, and all eyes will be on that 2027 listing to see how the market reacts. Thanks for joining me for this explainer, and keep questioning the strategy behind the brands you see every day.